people called this over on May 23rd. The correction hit hard, and the voices saying the bull market was finished got very loud. Raoul Pal said they were wrong. The liquidity flows were intact. The market proved it. What he sees coming this summer is what this video is about. Had you already heard of Raoul Pal before today? Drop a yes or a no in the comments right now. I genuinely want to know how many of this audience is already tracking his analysis. I'm Naeem, and at Crypto Newswire, we cover what is actually happening in the global financial system. This is not financial advice. This content is for educational and informational purposes only. Always do your own research before making any financial decisions. If this kind of global macro analysis is useful to you, hit the like button. It helps this channel reach more investors who need to see what is happening at this level. Now let me walk you through exactly what happened and what it means for the thesis you have been holding. The setup for what Raoul Pal is describing did not begin last week. It has been building for years. And if you have been a patient observer of the crypto market, staying in your position through the stretches where the news was bad, the doubt was loud, and the people closest to you were quietly questioning whether you had made a mistake. What he is saying here is going to feel like a confirmation of a thesis you could sense, but perhaps could not fully articulate. Raoul Pal operates from a framework he calls the universal code. The idea stripped to its simplest form. Everything in the global economy is funneling from energy into intelligence. The balance of power, economic power, geopolitical power, institutional power is shifting from whoever controls physical energy toward whoever controls artificial intelligence. This shift is not coming. It is already underway. And in his words, it is driving the geopolitical process, the investment process, and literally everything right now. Crypto is not a side story in that shift. It is embedded in it. The political layer is the part most individual investors tend to underweight. Raoul Pal makes an argument about the Trump administration that changes how you read the regulatory headlines of the past several months. The tech founders, the AI investors, and the largest backers of the crypto industry, the tech overlords as he calls them, who had previously been aligned with the Democrats, switched their political support before the last election. His read on why they looked at the timeline and concluded that this specific administration, during this specific window, was the moment when the rules governing digital assets and artificial intelligence would be written for a generation. The crypto lobby backed this administration because this was the chance to get the infrastructure of the new financial system locked in on terms favorable to the industry before the window closed. That context changes how you read every legislative headline. Raoul Pal says Trump is getting the Clarity Act across the line right now. It had to happen, he explains, because the crypto lobby needed it, and because a political deadline tied to the midterm elections means the window for passing it favorably is not unlimited. The Clarity Act is the legislation that would provide formal regulatory structure for digital assets in the United States. For years, the absence of clear rules created the single greatest structural obstacle to meaningful institutional positioning in this space. Raoul Pal is saying those rules are being written and passed now, not as a courtesy to the crypto community, but as a political and economic necessity with a deadline attached. He adds a layer about the political mechanics. For this convergence of AI, crypto, and the restructuring of global financial infrastructure to accelerate at maximum velocity, the most efficient path, the path with the fewest obstacles, runs through the Republicans retaining Congress in the midterms. He is not saying another outcome makes the thesis impossible. He is saying that in his framework where intelligence needs to accelerate, and the political environment is one of the inputs into that acceleration. This is the path of least resistance. Everything has to resolve, and it all has to resolve this summer. The second pillar of his setup is the Federal Reserve. Walsh has been voted in as the new Fed chair. Raoul Pal describes this appointment in specific terms. It is the Greenspan appointment of the era, a central banker who is going to run the economy hot rather than fight the growth cycle at every turn. What running it hot means for a viewer who did not spend a career in monetary policy. It means allowing the economy and inflation to proceed at a level that a more cautious Fed chair would tighten against. The theory is that the productivity surge, being driven by artificial intelligence, will bring inflation down over time without the Fed needing to raise rates to achieve it. Productivity takes the sting out of CPI. Technology is the cure, not the interest rate. Walsh is also described by Raoul Pal in highly specific terms: a tech accelerationist, a crypto advocate, and a prolific tech investor. Someone who understands the game. Productivity is the game. A Fed chair who genuinely understands that distinction, who sees the deeper structural process and is not simply reacting to a monthly inflation print, is a fundamentally different operating environment for the crypto market than what investors have been dealing with for recent years. Financial repression, a deliberate weakening of the dollar, easing financial conditions. These are what this appointment signals, all of which raises the question that neither the interview nor the commentary around it fully answered for investors watching from the outside. If Walsh is running it hot, if the Clarity Act is moving, and if the administration is aligned with the tech and crypto ecosystem, what is the actual financial mechanism that connects all of these macro developments to the crypto market? How does the money actually move? And what does Raoul Pal mean when he says, in a sentence that passes very quickly in this conversation, that stablecoins are so important because they finance the deficit? There is a sentence in Raoul Pal's interview that carries far more weight than the pace at which it is delivered suggests. He says the ESLR takes care of the short end, and stablecoins are so important because they finance the deficit. For a viewer who has not spent a career in financial markets, let me break this down carefully because it connects the crypto ecosystem to the US government's most immediate fiscal reality in a way that most commentators are not explaining to individual investors. The United States government needs to borrow to meet its spending obligations. And the question of who provides that financing is one of the central challenges in American fiscal policy right now. The Chinese, the Japanese, and the South Koreans owning as much of the long bonds as possible is an explicit goal of the grand bargain Raoul Pal describes. Because getting these countries to absorb US long-term debt is a core piece of the strategy. Stablecoins enter this picture specifically. A stablecoin is a digital asset pegged to the value of the US dollar, designed to maintain that value without the price volatility typical of other crypto assets. As the stablecoin market expands globally, as more institutions, businesses, and individuals around the world use dollar-pegged digital assets to transact, demand for the US dollar and for US government obligations connected to that market grows with it. Raoul Pal's argument is that stablecoin growth is in functional terms deficit financing. It is an alternative and growing source of demand for US dollar instruments that supplements the traditional foreign buyers. This is not coincidental. It is structural. This explains something most observers miss. The US government has a direct financial incentive to see the stablecoin market grow in a regulated and stable way. The Clarity Act and the stablecoin legislation moving through Congress are not just political favors delivered to the crypto lobby in exchange for support. They're also addressing a real US fiscal challenge by creating a regulated channel through which global stablecoin demand can grow and serve the Treasury's needs. The interests of the US government and the interests of the crypto industry overlap here because it is driven by necessity, not enthusiasm. The ESLR, which Raoul Pal names alongside stablecoins, addresses the short end of the yield curve from the banking side, and it complements the stablecoin side of the equation. Together, these mechanisms are part of a coordinated strategy to ensure the Treasury can place its obligations without depending entirely on foreign sovereign buyers who may have their own priorities. The international picture assembles the rest of the mechanism. Raoul Pal describes what he calls a grand bargain, a series of interconnected negotiations playing out simultaneously between the United States and its major global counterparts. The elements he identifies include China, Japan, and South Korea agreeing to own more US long bonds, trade agreements on who gets access to what technology, with Jensen from NVIDIA specifically named as a key presence in the China negotiations, because who controls access to the chips that run the AI race is one of the most consequential economic levers that exists right now. Agreements with Iran and Venezuela structured to bring the cost of energy lower. The UAE being given swap lines with the Federal Reserve. Besant, the Treasury Secretary, traveling to South Korea and Japan. Elon and Jensen and approximately 100 other American tech leaders went to China. Each of these moves, taken separately, could look like routine diplomacy. Raoul Pal is arguing they are the interlocking pieces of a single coordinated strategy. One designed to restructure who owns what, who gets access to what, and how global liquidity flows in the period ahead. The instrument tying all of it together is the dollar. Trump is going to negotiate with China, possibly offering them a lower dollar in exchange for their agreement to buy the long end of US government debt. A weaker dollar loosens global financial conditions. It makes credit cheaper in dollar terms. It makes capital more mobile. It makes assets that benefit from increased liquidity and expanded risk appetite more attractive. This is the liquidity channel that feeds into the crypto market, allowing the dollar to weaken, which weakens financial conditions, is an explicit goal, not a side effect. Raoul Pal is direct. His US liquidity chart is tracking perfectly. The flow is happening. It is on track for what he expected, and he still believes crypto will outperform tech stocks in the next phase of the cycle. Consider what this means for an investor who spent decades building retirement savings in a world structured around dollar stability. Someone who held a position in digital assets through corrections, through years of doubt, through being the only person at the table who understood why this space was worth watching. The deliberate engineering of dollar weakness, the global liquidity expansion, the regulatory framework coming into place. These are not distant monetary policy abstractions. They are the forces that determine whether the thesis that investor held through all of that was correctly aimed. But there is a variable in this picture that Raoul Pal does not address in detail, one the analyst covering this interview specifically flagged, and it could shift the timing of everything he is describing by several months. It involves a negotiation that is not currently going well. The analyst covering Raoul Pal's interview made a point at the end of his breakdown that deserves serious attention. That point is this: Iran's nuclear negotiations with the United States have stalled. Iran does not want to give up its nuclear options. The United States wants to get rid of them. That is the key point of contention. And right now, there is no resolution in sight. Iran and Venezuela are part of the same picture as the grand bargain, part of the strategy to get the cost of energy lower until the Iran deal closes. That energy price reduction does not materialize on schedule. Elevated energy costs keep inflation readings higher than they would otherwise be. And if inflation stays stubbornly elevated, the Federal Reserve cannot cut interest rates without risking a surge in consumer prices that would be genuinely damaging to real people, to purchasing power, and to the Republican Party's midterm election prospects. Rate cuts feed into the dollar weakening strategy. Rate cuts feed into the liquidity expansion cycle. Without the Iran deal, those inputs are delayed. The analyst's honest assessment. Raoul Pal's summer timeline may be optimistic by a few months. We might need to wait a couple more months than he is thinking. His read is that the inflection point may come closer to October rather than August, that the market will bottom out by October or in October. That is not a radical departure from Raoul Pal's thesis. It is a timing caveat sitting on top of an intact structure. Here is the larger pattern, and it is the one worth holding as the key takeaway from everything covered today. The crypto market does not move on technology alone. It moves when technology, regulation, global liquidity, and institutional positioning converge in the same direction at the same time. That kind of convergence is rare. When it happens, it tends to resolve in ways that surprise the observers who are watching only the price chart and not the architecture moving beneath it. The Clarity Act is moving toward passage. Walsh is at the Fed and is expected to ease financial conditions as the tech accelerationist central banker Raoul Pal describes. Stablecoins are embedded in US fiscal strategy in a way that gives the government a direct financial incentive to support the industry's growth. The US is in active negotiations with China, Japan, South Korea, the Middle East, and Venezuela on a restructured global financial order. The dollar is expected to weaken as part of a coordinated design. The US liquidity chart Raoul Pal tracks is, in his own words, tracking perfectly. None of these are speculative claims added from outside this conversation. They are all observable developments that emerge directly from what Raoul Pal described. What he is doing is assembling them into a coherent picture, one that most individual investors, watching a single price chart or reading a single headline, would never see in its full shape on their own. The thesis is intact. The timeline has one open variable, whether the critical chain resolves in July or September or October. Depends in part on a diplomatic standoff in the Middle East that is not currently close to resolution. But the direction of the underlying forces is not ambiguous. The regulatory trajectory, the liquidity architecture, the alignment of US fiscal interests with the growth of the digital asset ecosystem, these are moving in one direction. The patient investor who understood this picture before it became obvious to everyone around them is in a position that most people who dismiss this space are not in. That is not a prediction, it is an observation about what doing this work actually means. After everything we covered today, I want to ask you one direct question. What part of this global picture do you think the people around you have absolutely no idea about? Leave it in the comments below. I read every one of them. If this video gave you a clearer picture of what is actually happening, go ahead and like it. It helps this channel reach more people who need to see this. And subscribe so you do not miss the next one. Share this with someone in your circle who is only following domestic crypto news and has no idea what is happening globally. Stay informed, stay positioned. I will see you in the next